Alrighty, folks, we got to talk about some big things in the economy. We got to talk about inflation. Was that PPI reading something to be afraid of? Is it a sign of more things to come? Or are there details buried in it that may be not as concerning? And of course, we need to talk about the unemployment rate because, again, I am banking on a 50 basis point cut in September because I believe the unemployment rate is much worse than the headline number. But of course, we're going to talk with Mr. Dan Bird, who is always eager to disagree with me, and he brings the details and the data. Dan, how you doing this fine morning?
I'm doing good. I don't, take pleasure in disagreeing with you.
Oh, I don't mind. That's okay. I like learning. Disagreement is a healthy debate's important.
Absolutely.
Showing me new data, all of that. No, I
Yeah.
I think you do have fun though, educating me. I've known you for a long time. That's not new either. That's 10-year, 15-year, 20-year Dan. Always making Zuber better and a little bit smarter.
Yeah, that was a little dicey when you were my boss, but
Ah,
yeah.
no, hopefully never was. Never was. Well, where do you want to go first? This PPI number? Do you want to talk about
Yeah,
that?
let's start with PPI,
Okay.
and then we'll do that
Okay.
unemployment thing. That was a conversation we had 2 weeks ago that I wanted to follow up on because I put the data together for it. It's
Awesome.
very interesting actually.
Well, very good. Let's hit inflation first. Again, for folks that don't know, CPI came out this week, and I would argue better than expected. Not game changing, but better than expected. And then, boy, when PPI hit on Thursday, those numbers were all kinds of ugly. And I do think there's a story behind the numbers that most people are missing. But I'm curious what you saw.
Well, I same thing, and CPI came in as actually less than expected, but the same as last month, so pretty much flat over
Yep.
the month over month. So market liked that; they thought it was a good number, and it was. So the market went up. And then PPI came out much higher than expected, and the market didn't like that, and the market went down.
Mm-hmm.
So it's been a roller coaster ride this week.
Yeah. So did you actually take a peek behind the number, or did you just stay at the
I
high
did
level?
I did not. Just the high level, which we'll talk
Okay.
about. Um,
So let's talk about this because I have again the PPI number was so shocking that I went behind the numbers, and I think there is actually something very concerning that nobody's talking about. So let's talk about what people expected. So let's talk about what people expected in PPI when they saw the number. So what they thought they were seeing was this is the first real sign that tariffs are causing inflation. Because again, if you
right,
want to talk about inflation, you're going to see it, tariff inflation in PPI first. That makes complete logical sense
right.
before you see it in CPI. So that's what people thought they were seeing. That's not what was in the number. And
That they
nobody
were
is talking about this.
that they were expecting to see.
Right. What they were expecting. Again, right. So let's just say PPI came, I think it came in at like 3.3 or some nasty number, zero point 0.9 month on month, just a
Point
horrible
0.9.
number.
Yeah,
Yeah,
triple
horrible number.
triple the expectation.
But here's the deal. When they saw that, they thought it would be tariff induced goods inflation.
Right.
That
But it was
word
but it was
is
services. It was services instead.
bingo. 75%, 75 of the PPI increase was services. That's not tariff induced.
That's right.
Absolutely not tariff induced. Could be, again, according to Mark Zandi, we talked about on the daily financial news, it could be deportation related.
Ah,
Labor.
yes.
It's labor.
Yeah.
And that is interesting, right? Do you want wage inflation? Yes. Do you want wage inflation to the level that PPI goes up a full point in a month? Probably not, because that's like a 12% annualized number. So again, I think people got spooked by the PPI number. I think they instinctively thought it was tariff induced inflation and they missed the boat. It's potentially deportations.
Yes.
Or it could just be a makeup for wages not raised during the pandemic. So again, there's a lot of data there, but to call the PPI number tariff induced is to be uneducated and not reading below the headlines.
Yeah, I think the deportation comment is probably the most accurate. I think it is deportation. It is a sign of elasticity in the economy. In the economy, that elasticity means it will stretch and contract and it'll go back and forth.
Correct.
And it will show up in things like this, but it is not a permanent thing.
Well,
now let me go back and
sure.
look at that from the other side.
Sure.
So when we had lots of immigrants coming in,
mm-hmm.
what did that do? Made the employment numbers.
That's my point. It artificially depressed wages. And one of the big things economists like myself have been theorizing is what happened to the wage inflation during the pandemic? Because again, we saw some, but it was below total inflation because of this wild and crazy borders were open policy. Now we're making that up. So that's why I ask people to think about this. Because again, it could be deportations, it could be elasticity of the labor pool, it could be participation, it could be all of these things. Normally we want wage, this again is historical. We want inflation at 2%. However, we want wage inflation at 3%. Right? Historically speaking, economists is what we talk about. It's what we plan for. It's the Goldilocks economy. Right now, wage inflation is heading up more than 3%. Now, to your point, is this just makeup? I think it is. I think we had a labor pool that was artificially increased or goosed that is now being drained, and you're having to pay more. So I'm not saying it's a bad thing. I'm just saying it's probably going to be stickier than people think.
Mm-hmm. Yeah, I agree. And what does that mean for the Fed now? Does that mean they don't cut? You said a 50 point cut. I don't think there's going to be a 50-point cut, but will they cut in September? Of course they will.
Yep. Well, it's our second topic. It's our second topic.
Right.
It's the labor market. And
right.
So if you got nothing else on PPI, we should get to this participation rate.
Let me share, and I'll show you what I have. Perfect. So can you see my screen?
I can. Thank you very much.
Because I know we have a limited amount of time today due to technical issues.
Yes. Thank you, Comcast.
Yeah, but that's okay. First of all, this is my website, breakpointtrading.net. My YouTube channel link is right in the upper right. I'm doing a Zoom call for subscribers this coming Saturday, 1 o'clock.
Very cool.
So anyone that wants to join, it's basically I'll go over anything new on the website and then just open it for questions. It's very interactive. So anybody, we can talk about anything you want, talk about technical analysis, the economy, stock, individual stocks, whatever. They usually runs 2 or 3 hours. Mm-hmm. And I just stay on as long as I can. Now, this particular day, my wife is out of town.
So this will go long.
So I could go as long as I want. As long as my voice will take it.
Your voice.
All right, so let's first take a look at the newsletter, and I want to show you something that I put in here. Well, here's the Fed Watch. Mm-hmm. So here's 92% for a.
There was a day last week on Wednesday that the odds of a 50 were up to 6%, but that didn't last long.
Yeah, actually, the odds of a 50
are zero
right now. Right,
it was high as 6% on Wednesday before.
They actually are potentially 27% in December.
Yeah, there you go. That's true.
Right, that's assuming we don't get one in October. Then we could get a 50 in December.
Okay.
27%.
Yep.
But also December has a 72% of another quarter. So that means October potentially won't be a cut.
Yeah.
It's 52%. So it could still be a cut. So I don't think it's going to be 50 though, because of the PPI number.
Yeah, I'm going to stick to it. I like to stick to my guns when I make a call, but yeah,
I'm now putting the dot plot in the newsletter also.
Oh, that's nice.
So that's here. That kind of gives you the long-term view of where the different Fed governors are.
Yep.
All right. So let's go down here, and I will show you right here. Okay. So here's the CPI number, year-over-year change, and here's July on the right-hand side. So housing, actually medical care was the biggest component of it. So medical care is the biggest one that went up. Apparel, transportation, education went down. Goods and services went up slightly, just slightly.
Yeah. And this is why I tell my audience that the CPI number is bogus. Because when you look at the housing line, which again is the largest single
Right.
basket,
Yeah.
housing is not going up. Shelter is not going up 12%. It's just not.
Right.
It's wrong.
Right. Yeah.
It's badly calculated. It's lagging is probably the kindest thing I could say about it. But
Right.
that's why CPI is not as hot as people say it is. Just not.
These excerpts here, by the way, come from real investment advice. This website, this is a free newsletter, so I put the link to the whole thing here, and then I take excerpts out of it.
Mm-hmm.
So he's basically saying the same thing that I am. Does not mean the market's going to crash, but it is in a precarious position right now. Sure. And this is money flow, this orange.
Oh, wow.
So money flow is flowing out of the market as the market goes higher.
Getting tired.
Yeah, so that may not last. We'll see. And then this basically is the momentum. It's rolling over and it's lower, so it's a negative divergence. So I've been saying that for a while, actually. Okay. Mm-hmm. This is valuations are extended. There's 1999. Here's 1929. Here's where we are. We're actually coming down, but we hit that top right there. Mm-hmm. So it looks ominous, but doesn't mean the market's going to crash. Yep. So PPI. This week's PPI confirmed what we have been saying. Producers are eating the tariffs.
Correct. While
the PPI shows a significant increase, it was almost entirely contained to services.
Correct. And most people miss that. Nice job.
Right. Where tariffs have an impact. If we look at the spread between CPI and PPI, see that companies cannot pass those tariffs through to their customers. Risk to investors, this is important. The risk to investors is that if producers continue to absorb these tariffs, it will eventually show up in the compression of profit margins and earnings.
Correct.
That's what will happen to the stock market. That's the impact it will have on the market, because it's going to show up in earnings if the producers continue to eat those tariffs.
And it could be a double whammy if you're going into a bear market where the multiples are also getting compressed.
Right. Yeah. All right. So these guys, they've written a lot of articles about this. Tariffs are not inflationary. I've been saying that since the beginning. Reasons are producers pay the tariffs, not consumers. Consumers have choices. They can pick something else that doesn't have tariffs. And importers can eat the tariff to remain competitive. And here's the numbers. This is from Goldman Sachs. Exporters have absorbed 14% of the cost. Their share will rise to 25% if the more recent tariffs follow the same pattern as the earlier tariffs.
Yep.
All right.
I think that's fair.
And then I have a chart. This is from Goldman. 14% are being paid by the exporters. 64% are being paid by the importers.
Yep.
And only 22% is flowing through to the consumer. And then this is an interesting chart from Goldman as of right now, July. So without any tariffs, it's the red line. With the current baseline, it's the dashed line. This is what they expect the inflation to go to, 3.2%. Right now it's at 2.7, right down here. And the solid one is where we actually are, which is actually following that dash line. Okay. All right. So I don't think it's going to go that way, though. I think it's actually going to roll over and start coming down again. All right. So that's the comment about PPI and tariffs. So let's talk about the unemployment rate.
Yes, sir.
And let me show you what I put together. Let's see. So what I did was I took all the numbers, the unemployment rate and the participation rate, put them side by side. So these are the two charts. Remember I said last time, I'd like to see what that looks like side by side with the unemployment rate. Because the unemployment rate has been fairly flat, between 4 and 4.2. Went back up to 4.2, but it's been there for quite a while. Participation rate had been fairly flat as well until basically May.
Yep.
Actually June, so 2 months ago. It came back down to the previous low, but then it dropped below it. So participation rate the last 2 months has gone lower.
Correct.
Now, what I did to try to make a single trend line comparison between these is rather than using participation rate, I just subtracted it from 100 and I call it the non-participation rate.
Fair.
Okay. And then combine that with the unemployment rate, actually subtracted the two to create a trend.
What's the delta? Yep. I
right.
See it.
So the delta actually shows the trend, which you might think of as the real unemployment rate.
Yeah, U6. Yep.
Right. So that's what the trend now looks like. Clearly going higher. But then I also wanted to really understand what these two things meant. So I put that together. The unemployment rate right here, here's how it's defined. Percentage of people in the labor force who are actively seeking work indicates how many people who want to work can't find jobs. All right, it's used for economic decisions, wage growth, etc. Labor force participation, on the other hand, measures how engaged the population is. Declining rate may affect aging demographics, discourage workers, etc. Rising rates suggest more people are entering or re-entering. Right now it's falling.
Correct.
But then I wanted to know, what's the effect of retirees?
Yeah, demographics.
All right.
Yep.
So included in the participation rate, people 16 or older who are working, people who are actively working, looking for work.
Yep.
Unemployed, but job seeking. All right. Retirees who are not working, and this is what's not included. Retirees who are not working and not seeking employment. Students, stay-at-home parents, disabled, discouraged workers who've stopped looking for jobs. Why it matters: if a large portion of the population retires, which is what's happening now, as is happening with the aging populations in many countries, the participation rate can decline, even if the unemployment rate stays low. That's why economists often look at both metrics together to get a full picture of labor market health. So I would submit that while it is true participation rate is falling, causing the overall unemployment rate, the effective unemployment rate, let's call it, to rise, I don't think it is falling at a fast enough pace because of the retirees, the large number of retirees that are entering the marketplace right now. I think for this to really have a significant effect, number one, you need a little bit longer trend. So you need to watch this for a longer period. And I think it needs to drop at a faster rate to account for those retirees for it to really affect this over here. So yes, it is going up, but it's not really going up at a dramatic rate.
Yeah. So again, this is some work that I did. Again, don't have the proof here, but what I did is I took the participation rate from August right there, right? 62.7, either that month or the September one, because we were at 4.2%, just tying the two charts together.
Right. Yeah.
And the problem is we're now
that's these two data points right here.
Yeah, exactly. The problem is if you go to the right side of the screen now, or the right side of the charts, excuse me, you're 0.5% lower in participation rate with the same employment rate of 4.2.
Yeah, the unemployment rate is going sideways where the participation rate is declining. And that's pretty clear.
And I think that is a missing story, because if you were to go back and assume the participation rate was still 62.7, the unemployment rate would be close to 5%. And I think that is...
Yeah, I just don't know that you can do it that way, just because the two of them have such different ways of calculating things. I don't think that you can take the two and create a new unemployment rate out of it. They are two different things.
I believe, I might be searching for something. I might be looking for an answer to a puzzle that's not there. But I have been trying to seek out why I think the labor market is more broken than the headline numbers. And I hate waiting for these BS revisions that always seem to go one way. It's like,
well, yeah, I don't trust that. I've said that many times.
I'm trying to look for the trend early, as opposed to waiting for them to clean up their data.
Right.
And my as I still sit here this morning, seeing all of this and all of my readings, is I believe the labor market is far more broken than these government statistics are saying.
So going back to our conversation about immigration,
Mhm.
I think immigration would show up in the participation rate before it would show up in the unemployment rate.
Of course it would. Yes, of course.
So if we have fewer immigrants coming in, actually a negative flow,
Mhm.
then that should push the participation rate down.
I think it is.
Especially,
I think in
especially historically. Now, it might make sense to go back to, all the way back to 2020 with these charts.
probably 21, I would guess.
Yeah, say 21,
Yeah.
when the all
Because
the when the border
when the borders
when the
open.
borders were flung open,
Yep.
and
Correct.
then see what it looks like from that perspective. But
Yeah, that would be interesting. Well, let's
but the
see.
reduced the reduced immigration should absolutely affect what these look like.
And to
Among
your earlier conversation, it's going to impact services. Yes.
Right, yeah, it will impact services, but it is elastic, so it's not going to be permanent.
I'm trying to figure out what
In
that
other
means.
words, in other words, we'll get back to whatever it was in 21. We'll get back to that point. Elastic means it's going to go up and then it's going to go down, and then we'll get back to the mean. It'll be a reversion to the mean eventually.
Oh, wow. So here we go in participation rate in 2021. This is coming from Google's AI. It says it was
Right.
61.7.
All
And
right.
it was, and back in 2019, so pre-pandemic, it was 63.1.
Wow, it's even higher.
Yeah. So, anyways.
So
Anyway.
yeah, that's interesting. I would love to see a chart going all that far back.
Yeah.
I might be able to put that together. I mean, now that I have the basics for it here,
Yeah.
it'd be pretty easy just to add them in.
Yeah.
Anyway.
Yeah. Anyway, so again,
um,
so what's this? So let's kind of net this out for folks as we wrap up this week. So inflation, I'm going to say, kind of in summary, inflation currently isn't really showing up tariff induced.
right.
I think is showing far more in services. I think most people are missing that. And second, your point is somebody's going to eat these tariffs, and it's likely not going to be the consumers. It's going to
Right.
be the shipper or the receiver, and that's going to impact margins and the bottom line.
And mostly the receiver, which will eventually impact margins and earnings. And when will that show up? That's the big question. Will it be Q3 earnings?
Yep.
That'll show up, or
Or
will it be
Q4.
Q4 earnings? So
Yeah,
if it's not till Q4, then that's a 2026 story.
Yeah, it's probably Q4 majority, because I still think a lot of people bought early
Right. Yeah.
and they have that Q3 kind of adding.
Yeah.
It's just kind of how I sit here today. Yeah.
I think that's probably true as well. Let me just show you. We got 5 minutes. So one chart I want to show here, I put this in the newsletter and I got some questions on this from a lot of people. In fact, even subscribers, they wanted to know where to find this chart. This is it's a pretty interesting idea. Basically compares the 3-month from now VIX, the volatility index. So futures 3 months out,
right,
versus the regular VIX looks at futures volatility or options, the volatility in options 30 days out. So it looks 1 month out.
Got it.
But this other one looks 3 months out.
Hmm.
So if this is rising, that is saying that the 3-month, the longer dated volatility is rising faster than the near term volatility. All right, that's basically what this says. So this is rising, especially when it gets up over 120, and then it drops back down, which are these vertical lines right here. That's when we get close to a top.
Got it. Okay.
Not always right at the top, but that's when we're close to a top, and that could happen as early as Monday or Tuesday.
Okay.
So this is implying that may have started Friday with the PPI number, but there really isn't any major economic other than Jackson Hole next Friday.
Yeah, Jackson Hole. Yeah.
Until the next unemployment report, which is about 2 weeks out.
Yep.
So there's sort of a pocket there's a pocket in the next 2 weeks where there's not really much happening, not much in earnings coming. So it would be very easy for the market to push this down. It'll be interesting to see what the effect of the Putin-Trump meeting was, which is basically a nothing.
Photo op. Yep.
Photo op, yeah, didn't really have any effect. I think the market was hoping for something.
Right.
So I don't know what the futures will look like, but it'll be interesting to see what the reaction of that was.
Well,
And
the
then
good news. Go ahead.
Go ahead.
I was just going to say the good news is you get on your YouTube channel each day the market is open, and kind of do a what's what each and every day. So thank you for that.
Yeah, at noon I talk about what's happened up till then and what the market looks like. So this and it's still extremely bullish. I mean, yes, we had a pullback on Friday, but it wasn't really much. It is, by the way, for technical analysts, that is a bearish engulfing candle. That's usually a reversal. That means it's a red candle that completely engulfs the white from the previous day. All right, so that is a potentially a down signal, and there is a significant negative divergence in a number of things, and they've been showing up for quite a while, actually. So you got a negative divergence in both the relative strength and the money flow down here. Money flow is the pink line behind there. And then this bigger money flow right here is about to cross below zero. So that's going to be negative. That means money flow is flowing out. I mean, it has been. As this goes up and these go down, that's implying that all of this money is flowing out of the market while retail traders are buying. Wall Street is selling. Wall Street's getting out.
There we go. Wall Street doing their thing again. Well, Dan, you are amazing. Thank you for all your calls each and every week and your daily updates on your YouTube channel. Keep it up.
Bet.
You're amazing.
Yep. Anybody that is interested, just go to breakpointtrading.net. For our subscribers, I'm doing a Zoom this Saturday. So hope to see everybody there.
Thank you, buddy. Take care.
All right. Have a good weekend.